If you only do three things on the entire tax checklist, do these three. They're worth $8,000 to $25,000 a year for most S-Corp owners, and almost nobody has all three set up correctly. I'm Tom Woolley, founder of Today's CFO. Let me walk you through them. Number one, reasonable compensation. This is the salary you pay yourself as an S-Corp owner, and here's the problem. Most owners set this number by accident. Either your payroll company defaulted you to something, or your CPA suggested a round number, and a few years ago, nobody ever revisited it. But this one number controls three things: your self-employment tax, your QBI deduction, and your retirement contribution ceiling. So let me give you a quick example. Say you're pulling $400,000 out of your S-Corp and paying yourself a $200,000 salary, but the actual reasonable compensation for your role in your industry is $120,000. So that $80,000 difference is costing you roughly $12,000 a year in unnecessary payroll tax. Just from one number, nobody ever ran the math on. The fix is straightforward. Get a reasonable compensation study done. It costs about $100, and it sets the foundation for everything else I'm about to show you. Number two, the QBI deduction. This is a 20% deduction on your qualified business income. It's a 20% discount on the pass-through income, and a lot of owners either aren't getting it or they're not maximizing it. So here's the thing most people miss. Your reasonable comp directly affects your QBI. Set the comp too high and you shrink your QBI deduction. Get the comp right, and you can unlock $5,000 to $15,000 additional savings depending on your income level. See how those connect? So get the reasonable comp wrong and you lose on QBI too. They're not separate strategies, they are linked. Number three is your retirement vehicle. Most owners either have no plan at all or they have the wrong plan for their income level. And here's what I mean. A SEP IRA caps you at 25% of compensation. A solo 401k lets you contribute 23.5 as an employee plus 25% as employer. And a defined benefit plan can shelter over $200,000 a year in the right situation. So most owners are in a SEP because their CPA set it up 5 years ago and never revisited it. But your retirement vehicle should match your income level and your comp structure, and it should be reevaluated every year as your income changes. This is the third lever, and it connects directly to the first two. So your comp sets your ceiling, your vehicle determines how much you can shelter. Get them both right, and this one move alone can be worth $10,000 to $15,000 a year in deferred tax savings. So those are the big three, what we call them. And done right, they move $8,000 to $25,000 a year for most S-Corp owners, and they all connect to each other and work together. So get reasonable compensation wrong, and your QBI and retirement will both suffer. That's why we always start here at the tax checklist. It covers all 15 strategies, but these three are the foundation. If you want me to run the big three against your actual numbers and tell you where you stand, there's a link below this video to book a call. It takes 30 minutes, there's no cost, and you'll walk away knowing exactly where the gap is, whether or not we ever work together.